Welcome to Potentia's Mid-Year Outlook. My name is Kevin Swanson, and I'm the CEO of Potentia. Potentia now manages over $500,000 for individual investors like you. Over the last years, we've added tax, trust and estate services, and formed affiliations with real estate, insurance, elder care, and social security professionals, with the goal of empowering our clients to live their lives confidently. Thank you for your trust. 2024 has been a year of uncertainty, inflation, interest rates, looming recession fears, and what promises to be a historical presidential election again. Today's panel will be led by Todd Barney, who is a recent addition to the Potentia team as a private wealth advisor. Todd has a passion for global markets, wealth management, and client services, which has been cultivated over more than 20 years, representing some of the industry's most trusted investment firms, including Invesco, Oppenheimer Funds, and Franklin Templeton. Todd holds multiple certifications, including the Certified Investment Management Analyst, CIMA, Certified Exit Plan Advisor, CEPA, Certified Financial Planner, and the Certified Private Wealth Advisor, both of which are acronyms more easily pronounced when speaking Klingon. Our panel today is made up of private wealth advisors Austin Kuya, Adam Roberts, and aspiring private wealth advisor Chris Mead. Please welcome Todd Barney.
Thank you, Kevin. That's a great introduction, and I'm not fluent in Klingon, but we will see what we can do here to get everything started. Let me get the presentation up. Wonderful. As I said, thank you for that great introduction. I'm thrilled to be a member of the Potentia team and looking forward to success not only in the rest of 2024, but also for the years to come. As you said, 2024 has been dominated by many, many headlines, but today I thought I would focus on the four loudest that we've been hearing. First and foremost, inflation and interest rates, followed by stock market outlook overall, artificial intelligence, which has definitely dominated the headlines from a popularity standpoint, and then finally, the largest elephant in the room, the US presidential election. But before jumping into those, I thought it would be most helpful to give an idea of where we believe we stand today. That way we could talk about where we believe we're going, and most importantly, how the portfolios are positioned to capture those opportunities. So the slide you're looking at right now shows you that we believe we're at the later stages of the economic cycle. This means that we're still growing around the globe, but it's slower than it has been historically. Market sentiment is more to the risk-off category. People in general are being more cautious, a little bit more concerned about where we stand and what the outlook going forward is. And that's not surprising. We haven't even talked about the geopolitical risks, along with that US election and a few of the other extraneous forces outside of the financial markets. And then finally, at the bottom there, you'll see policy implications. Inflation remains stubbornly high, and those cries for interest rate cuts grow louder and louder each day. So when we talk about inflation, I think it's important to note and highlight that we have had a dramatic decrease in inflation. Just over a year ago, we were sitting at about 9%. The most recent readings had us just below 3%. It may not feel all that great yet, but we are seeing positive trends. And again, that's why the investing public are calling for the Federal Reserve to begin cutting interest rates. We'll actually learn more this Friday at Jackson Hole when Jerome Powell takes the stage and speaks to the world about the future of economic policy. And we do believe that you will see cuts forthcoming. The question about when and by how much are arguably the least important. What we found over time are trying to guess interest rate policy is a fool's errand. But what we do attempt to get right is the direction of those moves. And from the Fed themselves, they've been talking about maintaining the rates where they are and ultimately making the move down when the data supports that. To put this in context, we started this year anticipating the market overall, anticipating 5 to 6 interest rate cuts. And as of today, we're still waiting for that first cut. What has grown louder is the data to support moving forward with lower interest rates, which should be beneficial to both the stock and bond side of the equation of the portfolios. In fact, with the help of our friends at Franklin Templeton, we were able to take a look at the last 6 peak rate cycles and the way that different bond portfolios performed. If you look in here, you'll see going back to 1985, we used the gray bar, bank CDs, as short-term interest rate proxies. We've been having a lot of questions and comments about buying bank CDs or locking in yields, thinking that 1 year was attractive, but simply stated from the data here, historically, that hasn't been the case. In fact, in all but one of the last 6 peak cycles, CDs were the worst performing asset class. I would submit to you money markets would not be far behind, although not on this slide. What we've learned over the history and from the data showing us is times like this, we want to increase our allocation to bonds overall and slightly extend the maturities in order to lock in those yields. These are just modest changes on the margin, but what they do, and the reason we're doing this, are twofold. Number one, as interest rates come down, the value of bonds go up. So we want to do that before the Federal Reserve makes the move in terms of interest rates. Secondly, most bonds' total return comes from the compounding effect of the interest payments they make, the coupon payments. So by adding shelf life to that income stream allows for our clients to be able to benefit from a higher income than what will be available as the Federal Reserve starts to set those rates lower. That's why we're so excited about the fixed income side of the portfolio. And we've been adding in municipal bonds, which are tax-free, to complement the taxable bonds that we have here listed as well. Turning our attention to the stock market, what you'll find is a very interesting story also. As I said, interest rate cuts are beneficial to the stock market, but Kevin, to your point in the intro, it's been one great year. S&P 500 is up roughly about 16%. And the question I've been fielding is, number one, will it continue? Number two, what about this concentration risk that only a few companies are really responsible for this great experience we've been having? And then third, that the S&P 500 or the US stock market is expensive right now. In terms of the overall expensiveness of the index, let's start there. We'll start last first. Right now, the average price to earnings multiple in the S&P 500 is 21 times earnings. So it is slightly more expensive than the historical average. But when you peel that onion back, you'll find that that is because of those few names that have done so well, those large mega cap tech companies that we all know and love so much, because of their great performance, are skewing the results of the other 493 companies in that S&P 500. So what that's showing us is the headlines are accurate, but they could be misleading if we didn't take a deeper look and be thoughtful in our approach. What we've been doing with the portfolios under this, guys, is slightly taking some profits off of those magnificent 7, those big tech names, and reallocating into small and middle-sized companies. Why? When you look at those previous rate cycles, as the Federal Reserve lowers interest rates, more companies do better, and we want to be able to capture that opportunity. By making modest changes and only slight adjustments to the portfolio, what we're able to accomplish is participating in the upside and broadening of that market exposure. But if our timing's a bit early, it allows us to protect for downside and continue to have that exposure to those large cap companies. Opens up just a ton of flexibility and optionality in the portfolios. Now, you can't talk about the stock market without addressing the biggest theme of the year, and I would argue the next 3 to 5, even 10 years if some of the market participants are accurate, and that's that of artificial intelligence. Our friends at Grandview Research provided this, showing at the end of 2023, it was almost a $197 billion opportunity. As a reminder, when we build our portfolios of Potentia on your behalf, we start with that S&P as the core. That's our guiding light because it's the broad market that we want to have exposure to. We then augment with the fixed income or bond piece, as I talked about, because of that diversification and the compounding of interest rates. It also lowers the volatility of your overall portfolio. It helps to give a shock absorber or insulation to downward pressure on the stock market. What a theme like artificial intelligence does is it allows us to be more forward-looking, to look out 3 to 5 years for some opportunities, and artificial intelligence does exactly that. Now, I can't tell you if NVIDIA is the best company ever made, or if there's going to be a better option from an individual stock. But what gives us the best hope and the best insight into this opportunity is this pie chart you're looking at. It's impacting, and artificial intelligence is impacting, not only traditional industries, but non-traditional industries as well. I highlight agriculture. Agricultural companies are using artificial intelligence as we speak to increase crop yields, decrease waste, Deere and companies using artificial intelligence on their harvesters and combines in order to help the efficiency of farming overall. You're seeing it in advertising. The personalized advertising that's coming through is increasing the revenue per dollar of ad spend exponentially. You're seeing it in automotive, you're seeing it in manufacturing, you're seeing it in industrial logistics, increasing efficiencies, reducing waste, and providing for better outlooks going forward. What this also does is it allows us to invest in satellite opportunities that will benefit from artificial intelligence, but not make us beholden to any single technology. A great example of this is if you think back to the gold rush in California in the 1850s. Oftentimes it was more profitable to invest in picks, shovels, and gold pan producers than it was in the miners themselves. By us focusing on utilities or battery storage because of the energy usage that's required for artificial intelligence, is it allowing us to have exposure to the growth prospects, but again, not be beholden to any single technology. Now let's spend the last couple minutes talking about the biggest elephant in the room being the presidential election. Now, as Kevin said, this is a very consequential election. We've been told every presidential election cycle, every 4 years, this is the most important election of our lifetime. Socially, that may be true, but history as a guide says that economically and investment-wise, that may not be the case. What you're looking at here is a slide showing every presidential administration going back to the beginning of the S&P 500. So the mid-1950s, 1957 to be exact. And what you'll notice is there's a line across the page right around that 10% level. That's because the S&P 500 has averaged 10% returns per year, or just under 10% returns. What you'll also notice is that every presidential administration has enjoyed positive stock market returns over the course of their terms, except for two. The two at the bottom, President George W. Bush and Richard Nixon, are the only two to have negative total returns over their time frames, and both suffered the same end result. And that was they ended their terms in the middle of a deep, deep recession. President George W. Bush in 2008 with the housing crisis and global financial crisis, and President Nixon resigned in the middle of the 1973-74 recession. Other than that, no political party can take credit for a better stock market return or investment outcome, regardless of affiliation. The other piece that comes out every presidential election is that we're worried that one candidate or the other is going to completely re-engineer the U.S. economy. Again, looking back over the beginning of the 1950s, 1957 for the S&P 500, that simply isn't supported. 2/3 of the U.S. economy is built on consumers like all of us on this call. The other 1/3 is made up of government spending and business spending. And the percentage changes over the course of history have been minute at best. Nobody has been able to re-engineer the economy. The third piece I'd like to bring up when it comes to the presidential cycle is that the obvious trade may not be so obvious. If you go back to President Trump's first run, he ran a very similar speech and stump speech that he is today. Drill, baby, drill. Conventional wisdom said you have a president that's coming in that's going to extend the XL pipeline, going to open up more areas for drilling, and is running on the idea of energy independence for the United States. We should only be buying commodities companies. With the benefit of hindsight, unfortunately, that couldn't have been further from the truth during President Trump's term. Alternative energy producers, solar, wind, those were the ones that appreciated most in value under President Trump. Fast forward to President Biden's election, he comes into office and everybody says he's the new president. It's the Green New Deal. Alternative energy producers are going to be a home run. Again, with the benefit of hindsight over the last 3.5 years, unfortunately, the exact opposite has happened. Energy companies have done much, much better, even with the cancellation of the XL pipeline, even with restrictions on drilling, and those alternative energy producers have underperformed greatly. Why? Interest rates matter. Fundamentals matter more than who the resident of 1600 Pennsylvania Avenue is. Under President Trump, he enjoyed very low interest rate policy. So those companies in alternative energy were able to borrow money cheaply and being able to grow and innovate and go after that research and development. Under President Biden, as we just highlighted, interest rates were risen from 0% or close to zero to over 5%. Those companies in alternative energy that are so capital intensive found it harder to borrow money and to finance that growth. So be wary of those obvious trades that we see because of the change in political landscape. Fundamentals matter most. final proof point to that would be looking at this slide here, where we want to focus on the innovation coming from the companies, not because of our political affiliation. The overarching theme to take away from the political aspect of this is that investors care about elections, but markets simply don't. It's about the innovation coming from the companies. It's about the growth prospects that are there. It's about the strength of the overall US economy leading into an environment and how accommodating the central bank plans to be. I submit to you where we stand today, looking forward to a solid stock market where wage growth has been acceptable, unemployment is near all-time lows. You have a Federal Reserve that is on hold on interest rates and indicating that they are more than willing to move lower once inflation is showing that it is moving in the right direction. And the innovation of US companies is still alive and thriving. Lead me to believe that we're going to have a very successful end of this year and lead us in and propel us into 2025 and beyond. So with that, I'm going to pause and turn it back to Kevin.
Thank you, Todd. This is all really good. We've got our panel coming in now to ask a series of questions. I'd like to start that off, just say, recently US News and World Report said that 3 out of 5 people believe that we are currently in a recession. Any comments about that?
I shouldn't smile because it's not a laughing matter, but that is absolutely right. Kevin, you know me, and our clients are to get to know me more. I'm a huge music fan, and I love U2. One of their songs, One, opens up with the best line ever, and it's, is it getting better or does it feel the same? And that's the challenge we're running into. Markets are forward looking. Us as investors, because of the way that we're wired naturally, continue to extrapolate out past feelings going forward. Coming out of the recession caused by COVID, we experienced rolling inflation and then ultimately rolling recessions as well. And that's what you have coming across the board. So I would argue that no, we're not headed into a recession because of the Federal Reserve looking to lower those interest rates, not necessarily putting gas on and hitting the accelerator, but also not keeping their foot on the brakes. So it's accommodative monetary policy that will help to alleviate this problem. Wages have been growing, although not as fast as we would have liked. But the biggest feeling as to why we don't feel very good is that stubborn inflation. And as I said, it's below 3%, but it's still much, much higher. And goods cost more than they did 2 to 3 years ago. We are improving just much slower than all of us would have liked. I'd call that a side effect to the on-demand economy we find ourselves in right now as well.
Yeah. Adam, Austin, Chris, you're on.
Todd, so we've seen the stock market hit new highs this year, right? I mean, today, like you said, S&P 500 is at 5,600, which accounts for a 16% increase year to date. So I'm going to cheat. I'm going to ask 2 questions. Do we expect this momentum to continue into next year? And what economic factors will we be looking out for?
Absolutely. Thanks, Austin. Always starting with the easy one for me. Thank you. The short answer is yes, the momentum should continue. Will it be as aggressive as we've experienced over the last few months? I think so, but we have some challenges we need to get through. As you and I and most of the folks on the call know, the market hates uncertainty, and we are not short of uncertainty around the world. With the geopolitical risk coming out of the Middle East, with the political issue happening here in the US, the only promise I can make is that the stump speeches are going to get louder, the rhetoric's going to get louder, and that's going to provide some challenges that will come through. But again, using history as a guide, the fundamentals are rather strong, and as that uncertainty comes out, regardless of people are happy or unhappy after the election, we have clarity of purpose going forward, and that should allow for a stronger economy going forward. Again, I'm focusing mainly on the interest rate policy, because as borrowing costs come down, you'll have consumers that'll be more likely to spend and businesses more likely to spend. And that's where I believe you'll have that flywheel start to take effect.
All right, I have a question. Recent CPI data suggests we're finally looking at interest rate cuts. Do you think the Fed is behind the curve on cutting rates, given the slowdown in the labor market?
Thanks for the question as well. Another easy one. No, I don't think the Fed's behind. The Fed is being accused of being behind because when inflation was starting, they used the term transitory and were very slow to start on the increase in interest rates. They have absolutely learned over the course of that time that they wanted to be more data dependent and be more cognizant of it, which is why we opened this year in the anticipation of 5 to 6 rate cuts. What's interesting is because the market's forward looking, as I was talking to Kevin about in the previous question, you're seeing that in the bond market as well. So the 10-year treasury and other interest rates have already started to come down from their highest levels in anticipation of that Fed cut happening. So sometimes the news is just as effective as the actual movement taking place. And that's what we've seen. Now, the Federal Reserve stands ready to act. And as I said, we'll have more clarity on Friday when Jerome Powell gives his speech. But it should be just enough to give us the inclination that they are apt to move, but not to address that they will be moving in the September meeting happening the 17th or 18th.
Todd, we've been focusing heavily on the US, right? And you kind of alluded to it a little bit earlier with some of that uncertainty in the market. So we're obviously seeing those global conflicts continue. We don't really see a end, unfortunately, to those anytime soon. Is now a good time to invest overseas? I mean, if we're thinking of interest rate cuts, maybe a weakening dollar, what kind of opportunities are there overseas?
Absolutely. Thanks, Adam. I would say that we're evaluating overseas as we speak. It's been a decade plus of underperformance of international markets to the United States, and that simply can't last forever. But we also can't invest internationally just because things are cheap. We need that catalyst for growth, what's going to propel those companies to do better. You highlighted a couple that will be there, absolutely. Interest rate cuts will have a natural effect to weaken the US dollar. And we don't need the dollar to weaken dramatically, but just to start the downward trajectory would be very, very helpful. You're seeing countries outside the United States that are starting to show those green shoots. Japan, for example, is one that's been very, very interesting of late. They finally, after almost 3 decades, were able to get out of negative interest rates, be able to start showing some growth and returning wealth back to shareholders. The challenge we have in the developed world are a lot of those central banks are cutting interest rates as well. They're in a similar economic issue to the United States. So I would say that it's too early now to be looking there, but it's absolutely the conversation that we're having in the investment committee, and we'll be ready to start allocating there when the signs get stronger to do so.
Todd, I love that beautiful pie chart that you had on artificial intelligence and all of the innovation since '08. I wanted to ask specifically, what are some opportunities in the market that we should be paying close attention to?
Sure. Opportunities abound, and I know it doesn't seem that way, and please excuse the cliche, but again, it's taking that deeper look that we do in the investment committee and making those decisions. As I said earlier, smaller and middle-sized companies haven't performed as well as the large mega cap tech, so we've added some of that into the portfolio in order to capture those opportunities. To Adam's question about the international space, that's very, very attractive, starting to be there, but hasn't been included in the portfolio yet. I'd say the bond market is where we're finding some of the best opportunity, adding in some of your tax-free municipal bonds because they have non or negative correlation to the stock side. So you get the benefit of diversification. And because of the higher yields for high income earners, especially here in California, you're able to get a much better tax equivalent yield by not having to pay federal income tax or state income tax on those interest payments. So there are opportunities clearly throughout the different asset classes. The challenge is we've become addicted to those large cap tech stocks because they've dominated the news for so long. And that's why I emphasized making modest adjustments at the fringes to be able to participate on those upside and then make a more concentrated effort when we get there. An interesting piece to that is also, if we're right and this slow growth environment continues, growth companies actually command a premium. That's part of the reason that these growth companies do well when it's a slower economy. People look for those companies that continue to grow. So we don't want to abandon those or make a tectonic shift from one to the other, but we want to complement those cases to be able to participate in the early innings.
All right, Todd. How do you think the ongoing conflicts in the Middle East and Europe will impact the returns for the US stock market?
Geopolitical risk is the most difficult to handicap, almost as difficult as trying to deal with the presidential election. I'll give you an example. When Russia first invaded Ukraine over 2 years ago, the idea was that unfortunately Europe was going to suffer a horrible winter and they weren't going to be able to have gas prices. Natural gas just skyrocketed in terms of value. That unfortunately, or fortunately in this case, did not come to fruition. So those investors that chased those returns in natural gas, thinking that geopolitics were going to be that major impact on those natural resources, unfortunately, those that came in late did not enjoy any of the positive returns or a majority of those positive returns. Unfortunately, from a humanitarian side, it is absolutely horrific what we're seeing. The best thing that could happen investment-wise is to simply have more clarity. A ceasefire would do a great good for all of us, and if that any resolution to Ukraine and Russia would be helpful. Now we're also bringing in, because of where we are in the time of the year, weather again. Thankfully, we've been able to export natural gas to Europe. They've been able to build the stockpiles with some mild winters, and that isn't as much of an issue. But you are seeing some concern in European manufacturing because they use that to finance a lot of, or excuse me, fuel a lot of the manufacturing. So definite areas to keep our eyes on. That's why we build those geographically diversified portfolios. And part of the reason I'm hesitant to say now is the time to start adding in international.
Thank you, Todd. I want to go back to the buzzword that Kevin mentioned earlier, recession. Right? We saw Home Depot come out and say, "Oh, we're looks like we're heading into a recession." A few days later, we saw retail sales just below expectations, and everyone's saying that we're not heading into recession. Consequently, we also saw unemployment rise and triggered what's called the SOM rule. Should we be paying closer attention to these rules that they're putting around the stock market? Why or why not?
Absolutely. What you just highlighted, Adam, is exactly why I opened with where we are now. Late in an economic cycle, conflicting data points are absolutely everywhere. And with the media circus that we're in with 24-hour media, everybody looks for that one piece that's right to be able to not only pat themselves on the back, but earn credibility. The SOM rule, for those that are unfamiliar, is a basis on unemployment. And if it moves up dramatically in a 3-month span, that's been a 100% predictor of recessions. The challenge is no individual data point can absolutely point to 100% accuracy in predicting. Yes, it may be coincidental, but it is not 100%. Another example that you've heard over the course of this year, and actually stemming into last year, is an inverted yield curve is a predictor of recessions. One thing I can promise, we will absolutely have a recession. The timing is the question. And when it does happen, which normally folks realize we were in a recession after the fact, you'll find those folks that go through and point to it. I'll tell you, very few rules of a recession are being violated now. We're not having a spike in unemployment. We're not having a blowout of credit spreads where junk bonds or companies that are below investment grade to borrow money have to pay exorbitant interest rates. You're not running into those traditional measures that say a recession is on the offing. 1 or 2 rules may be violated, but not enough to say, yes, a recession is coming. It's something that we're watching very, very closely, but I'm not concerned about that at this point. Again, going back to the central bank being committed to taking the restrictive piece away. And if they needed to, could simply move from tight monetary policy and go straight through into accommodative if they needed to. That's what we'll keep our eyes on.
All right, so last question. I'll end with an easy one. Can you talk about the most recent changes that we made to our portfolios and our discussions on why we made those changes in our investment committee meeting?
Absolutely. Thanks, Austin. And I do appreciate the easy one to end it. But yes, as I said, I alluded to a few of the changes. We're adding more bonds into the portfolio with slightly longer durations or maturities for the reasons I cited. We want that shelf life of the income. That chart I showed with our friends from Franklin Templeton showing how different bonds perform better at the previous 6 peak cycles. And we're also adding in more of the tax-free bonds for those taxable accounts. The challenge that you have when we're trying to balance fixed income and bonds is there's only 2 ways to get higher interest rates. Either you go longer in maturity and take more interest rate risk, or you go down in credit quality and take more credit risk. And our investment committee, as you know, has been harboring and harping on that fact of how do we strike that right balance? And that's where municipal bonds fit in. They're very, very strong credit ratings, so they're not junk status. And because of that tax-free nature, I don't have to reach as far out in terms of maturity to get a substantially higher yield. So it's really filling both buckets for us. and our qualified accounts, our retirement accounts, we're adding in more of the taxable bonds, but adding in slightly longer durations there because we want to stick with treasuries and agencies to get that diversification. Corporate bonds are attractive, but the issue is for corporate bonds, if the market becomes more volatile, those bonds are more volatile because it's trading on the credit worthiness of the company, not on the fundamental of the bond itself. So municipals or governments where we can use those. The stock side, as I said, the large cap growth has done very, very well. S&P's done well, but we're allocating into small cap value because value is one of the most overlooked asset classes when you get to the smaller names. And what they do is they provide very similar upside participation to small cap growth or the Russell 2000, if you recall that index, but they provide better downside protection. And so if there's one theme I want to get across when it comes to our investment committee and the way that we're looking at the portfolios is that we're monitoring the markets. We're making these modest adjustments, but we're doing it thoughtfully from a risk perspective first. We don't want to be overly greedy at this time, but we want to make sure that we're able to participate in the upside. But most importantly, if the timing's slightly off, or if some of these pieces that are priced for perfection don't take place, then we're not going to be hurt as well. So we're really bringing that balance, and those would be the biggest shifts that I'd highlight in the portfolios.
Todd, thank you for that. On behalf of everyone here at Potentia, I can honestly say we are absolutely thrilled to have you a part of our team. Thank you for sharing this meaningful and insightful perspective on the markets. To all those listening at home, if you have any additional questions or would like to continue today's conversation, please don't hesitate to reach out to your advisor. A very special thank you to our operations team for putting this presentation together. And thank you for joining us. Bye-bye.